How's it going today, folks? All right, so today I wanted to outline a new set of ETFs that have come to market. These are weekly paying ETFs and are not based on option writing. They're not based on covered calls. They're based on leverage and based on profiting from levered positions on a weekly basis and paying you out on those profits on a weekly basis. And they are from Roundhill. They have a number of weekly pairs, some like HOOW, or whatever it's called, and a number of others. So I want to walk through all those and evaluate, are these a buy right now? Are they a monitor? Are they a hold? What do we think about these? Let's jump right into it. All right, guys. So we're here at the Roundhill website, and you can see that they have a number of new weekly paying ETFs, like Apple's weekly paying ETF, AMD, HOOD, Google, Coinbase, Berkshire Hathaway, Meta, Microsoft, MicroStrategy, Netflix, NVIDIA, Palantir, and Tesla. So all of these our positions, primarily levered positions, not really holding the underlying asset. Maybe a portion is holding the underlying asset, but the majority are holding levered swap positions at 120% leverage. And with that, they're able to pay out a distribution based on weekly profits. So this is by no means anything to do with covered calls. These are looking at selling weekly positions, levered positions, and with those capital gains, you will be getting out a weekly yield. All right. And so a great example of one of the more successful ones that they've had is the Robinhood one, which has a expected trailing 12-month return of 120%, and a 30-day yield of 3%. Now, this is all about being a bull on these companies, and these ETFs will perform phenomenally in a bull market. All right, so it says here, there's no guarantee the fund will successfully provide returns corresponding to 1.2 times the calendar week total return common shares of HOOD. All right, so they're expecting to do 1.2, but there's no guarantee. And with these, like I said, you are capitalizing on a benefit in the sense that you're getting a levered position. And so if you're a bull on any of these individual stocks, as I mentioned, let's look at the weekly payers, whether it's Apple, whether it's Robinhood, whether it's Palantir, NVIDIA, Netflix, Coinbase, and you're okay with their strategy, this might be something to consider. So as I mentioned, they would be paying out weekly with this. You get enhanced exposure with the fact that it is a levered position via swaps. You get that powerful combination of individual bets. In this case, this isn't a market ETF. This is an individual ETF. So if you're bullish on an individual stock for its potential, you get to have the combination of that stock's price appreciation plus a weekly income from selling a portion of the capital gains. Okay. Now, this is a very, very high risk strategy, and all these stocks and all these ETFs are very new to the market. And so not only do you have to be comfortable with buying individual stocks in this case, individual positions, you have to now be comfortable with leveraging, utilizing leverage, utilizing loans, effectively margin, to amplify your position. And on paper, it all sounds fine and dandy, right? 120%. 3% yield over the past 30 days. Robinhood, an amazing stock. Well, that's fine and all great when things are going well. But keep in mind, on the way down, you're also being impacted 1.2 times, right? So you're not just going to get the negative impact on a one-on-one basis with the shares. You're going to be 1.2 times as affected as just owning the underlying stock. All right. So now let's look at some of these by way of total return, and you'll see kind of what I'm talking about when it comes to some of the ones that I've done very well and some of the ones that are lagging. If we go into Seeking Alpha, you can see all the ETFs I've set up. I've set up the HOOD one, the AMD, Meta, Coinbase, Apple, NVIDIA, Palantir. All right. And let's look at price return. So for price return, you can see Robinhood has done great, right? The underlying stock has performed well, really well, is one of the best stocks at the moment. So of course the price return has been great. AMD, not so much. Even Meta, it's kind of floundering, not so much. Maybe it's done okay, but remember, they also have to pay you out. So they might return a bit of capital to you. Coinbase, price return, negative 15%. Apple has had a very weak year, negative 24%. Even that's NVIDIA. Even NVIDIA over the past year is negative here, right? Whereas NVIDIA, the actual individual stock, has done pretty good. Remember, this is just price return, and Palantir is at 6% return. That's not the full story. Let's look at the total return. Now remember, like, you're not going to get amazing price return with these outside of like the ones that really pop. So Robinhood is kind of like an exception, right, guys? Like, be careful with these. Like, ultimately, be careful with these. But and these are also very, very new funds, right? Look, June, they just came out this year. July, June, Coinbase a little bit longer in February, Apple, February, NVIDIA, Palantir, and I can show you the rest of them. All right, so I've added in a couple more here. I've added in, look at the ones that we have here. So Microsoft, even though that stock has done well, negative 5% price return. Tesla, negative 27%. Netflix, negative 13%. Google has actually done decent recently, so up 21%. Now, looking at total return, you're going to see a different story, right? Microsoft, no return. It's also very new, but no return. They haven't had too many distributions. Tesla, up 6%. Netflix, negative 4% total return. Google, decent total return. Guys, these are not covered call strategies, so there's no guaranteed income. These need to be in a gain. These need to be gaining and appreciating to get strong payouts. If it's giving you distributions on the way down, they're pretty much just selling the actual underlying asset and returning to you capital, right? So ultimately, guys, like, all these ETFs, number one, are super new. And you really have to like know what you're doing here. You have to know what you're getting yourself involved in. You're getting yourself involved in leverage. You're getting yourself involved in individual stocks, and you have to kind of have a lot of conviction in that individual stock and not just ride it because it's been up. Like Hood, obviously, yeah, great. Robinhood, 55% gain in like a 3-4 month period. Phenomenal. That's great on paper, but is that always going to hold true, right? Are they going to have a down period, right? Are we about to experience a down period for Robinhood? I have no idea, but I can tell you that, once a down period comes, a lot of these gains are going to be wiped away. Yes, you get the distribution, so it's unique in that way. You're getting a capital gain payout as a distribution, so that's interesting. So ultimately, guys, like, if you're seeking weekly payouts, if you're bullish on an individual investment and are comfortable with levered positions, this is something to consider. For me, it's a monitor. I'm not really going to be jumping into any of these funds. I'm going to monitor them and see what happens after a year period. Let's give these a year before we jump in on them and go crazy. Right? Everyone wants to focus on like the new trend, what's hot. Like yesterday it was ULTY, now it's this. Tomorrow, who knows? But also, at the same time, if you just are bullish on any individual position, think about just buying the underlying asset. This is moving kind of away from income in a way and just kind of like harvesting your gains. Yes, you get the leverage. So like if you're keen on like that levered position, then this is interesting because you get that leverage, but you're going to feel the impacts and negative impacts of that leverage on the way down. So I would be very cautious with this and monitor this. Outside of that, guys, if you guys want to join the Patreon, I have a Patreon group. You get access to all the calculators that I have. You can do one-on-one coaching. And right now we have 55 members. Let's keep growing the Patreon, guys. So please sign up to the Patreon. I'll leave the link below. And one last thing, in terms of taxation, you can see that they are returning to you return of capital. So these are tax efficient assets in that way. And we know we've spoken on return of capital before. It's reducing your cost basis, and you're not incurring a tax when you actually get the distribution. You'll pay the tax when you pay the actual underlying asset, when you sell your asset rather. So that's one benefit there. But outside of that, guys, let me know what you think. Is this a buy? Is this something you're going to consider? Leave a comment below, sub to the channel, and all the best, guys. Cheers.